The next $500 is likely to be higher due to the conditioned global secular changes manifesting in macroeconomic and fundamental behavior of markets. That also happens to be a logical place for gold to go post its breakout from the cup and handle formation. So somewhere between 3,000 and 3,200 if this pattern holds true. And I don't really see any reason why it wouldn't hold true.
Recent gold price predictions from various market analysts and forecasting agencies paint an increasingly bullish picture of the precious metal's future. As gold continues its impressive rally, having surged over 20% year-to-date, multiple forecasters are aligning on projections that suggest sustained upward momentum in the coming years. VinceLanci, a respected commodities trader renowned for his insights on precious metals markets, has set an ambitious target between $3,000 and $3,200. His forecast stems from observations of significant global secular changes impacting macroeconomic fundamentals, bolstered by technical analysis showing a promising cup-and-handle breakout pattern. The economy forecast agency's projections closely mirror Lanci's optimistic outlook. Their analysis suggests that gold will trade between $2,800 and $3,200 in 2025, with a potential upside to $3,300 by October 2028. While Wallet Investor presents a more conservative near-term view, projecting gold at $2,721 by end 2025, their longer-term forecast remains decidedly positive, anticipating prices to exceed $3,000 in the 2026 to 2027 period, 2028 period, and ultimately reaching $3,236 in their 5-year outlook. Lanci attributes the rally's foundation to a pivotal shift that began in November, driven by central banks and BRICS nations actively reducing their dependency on the US dollar in preparation for an emerging multipolar world order. Multiple fundamental factors support the current gold rally. Market expectations of Federal Reserve interest rate cuts have provided significant momentum, while strong central bank buying continues to underpin demand. Asian markets have shown a robust appetite for the precious metal, further strengthening its position. Additionally, gold's traditional role as a safe haven asset has gained renewed importance amid escalating geopolitical risks and uncertainty surrounding the upcoming U.S. presidential election. Before we begin the video, please subscribe to our channel and hit the bell icon so you never miss an update. Also, share this with your family and friends who might benefit.
The chart you see there is essentially a timeline of events that we've talked about between the beginning of this most recent rally and today. Now, let's get to it. The gold market has had a tremendous run-up starting in November of last year and picking up steam in March of this year. The initial buyers bought for de-dollarization reasons, central banks looking to get out of US dollars, and BRICS countries preparing for a multipolar world. Those buyers are still buying and will likely be buying for years to come. The next cohort of buying came from macro discretionary funds, which are big, patient, and take positions for long-term ideas. While not as big as central banks, they are as smart and know a thing or two when they see it. Buying alongside them were China commercial banks and Shanghai traders who understand the policies of their own government, like the China Hunt brother that we've discussed in this space. And they also see the eventual future monetary system playing out. These SGE types should be viewed as PBOC-backed hedge fund types, and they are the ones, incidentally, that inflicted the pain on the bullion banks. JP Morgan was the one that was named there. That's how we got to where we are. This is where we are right now, and the purpose of this is to talk about the next $500, which should be higher, and the next $100, which could be lower. And it's a reality check going into probably the most tumultuous time in the gold market since 1999 or since 1980. And most recently, American small fund buying came in. That group of buyers, including CTAs and ETF buyers, have been really just starting to buy, as they frequently do during buy season. Most of them decided to pull the trigger in anticipation and right after the Fed decision to cut rates came in. These buyers are still active and have about $3 billion to buy this month alone. We go into detail on that at the bottom, but this is no small amount. The last 2 days have shown what that kind of money can do to a market. These are the last 2 days. At 9 a.m., Silver's on the left and gold is on the right. At 9 a.m., silver had a mighty spike, as did gold had an even bigger spike. And then at 10 a.m., they backed off almost to unchanged for silver, but gold held its gains for most of the day. Yesterday, silver had a tremendous rally, but gold came in barely up, right? And then it ended up down. You can see that there is an obvious pattern here for only 2 days, but it's a pattern nonetheless. And that pattern is that these ETF and CTA buyers are piling in droves. It's also a pattern that they're being absorbed. So if you want to look at it as a battle, it's the buyers. How much do they have to buy? How much gunpowder do they have? Versus the sellers, who we have no idea who they are. But we're going to discuss that a little bit more. The last 2 days, as I said, are the beginning of a pattern. All these buyers came in for various different reasons, all these various cohorts. The never-ending deficits, the need to de-dollarize, the new mercantilism, which demands all nations reshore their own money. That's right. Reshoring of supply chains is also reshoring of payment chains or money chains. The taste of the 70s and the Fed cuts likely to restoke that inflation. The geopolitical problems, which are auguring in a new Cold War with hot wars in every corner of the globe simultaneously.
VinceLanci notes that with the end of the fiscal year approaching, a selling season is beginning, yet gold prices continue to rise, driven by new buyers entering the market. This overlap of buy and sell seasons creates a distinctive market environment. The precious metals performance has been particularly noteworthy this year, demonstrating remarkable resilience by returning from earlier lows. With approximately 12% gains in major trading venues like COMEX and MCX, gold has maintained its upward trajectory across international and domestic markets. This sustained strength reflects a fundamental shift in market dynamics beyond seasonal fluctuations. Gold continues to attract investors in today's unpredictable economy. This year, precious metals have repeatedly broken price records as people seek ways to protect their wealth. With rising inflation concerns and global uncertainties, gold's role as a safe haven investment is particularly strong now. Lanci notes that a particularly interesting aspect of the current market dynamics is the changing profile of gold buyers. These new market participants, whom he characterizes as normal people, approach gold investment with different time horizons and risk tolerances compared to traditional institutional investors. Let's get back to the video.
The one thing they all have in common, all these macro discretionary guys, the CTAs, the ETFs, even some of the BRICS traders, they're all aware that the US election is coming up. And being aware of that event forces a long fund to think, do they want to take some profits? Some are actually taking profits now on a portion of their portfolio pursuant to making billions in this run-up. Some are also selling as their fiscal year is ending. Sell season is occurring as predicted. The market doesn't have to go down during sell season, but gold continues to rise, amazingly, right? It rises because of these newer buyers who have been forced to push up their scheduling due to the election and the Fed cuts. In effect, buy season is now overlapping with sell season. These buyers have absorbed, as you saw in that previous chart, the liquidation of some of the bigger players that are selling. We cannot bet on that to keep happening forever. These newer buyers have a different timeline, a different temperament, less settled, and shallower pockets than most of us in this regard. They are your neighbors. They're just normal people. This chart is the $500 higher chart. I posted them out of order, so let me just go through it right now. The next $500 is likely to be higher due to the conditioned global secular changes manifesting in macroeconomic and fundamental behavior of markets. That also happens to be a logical place for gold to go post its breakout from the cup and handle formation. So somewhere between 3,000 and 3,200 if this pattern holds true. And I don't really see any reason why it wouldn't hold true. However, the next $100 can be up or down, can easily be lower. If more of these macro discretionary funds consider lightening their load before the election, they all remember what happened in 2016 when Trump won. The market screamed higher, only to get stomped on that very night. It makes sense for those of them who are paying attention to the election, as much of a crapshoot as it can be, to say, maybe we lighten up a little bit here and be able to buy the dip if it comes election night. Trade around the core position. This chart here, same chart as before, the macro discretionary originally created by Goldman but marked up by ourselves. This chart here, the purple rectangle, that's where all the small money started buying. They started buying in this area. And that purple line I drew there, that purple line is their average price that they're in. So if you were to aggregate all the buyers between when the CTA started buying and now, anticipating the Fed and the actual Fed cut, their average price is long at 25.50. It stands to reason if we get below their collective average price, they will start selling. 25.50 is a magic number for me as well as for banks that are looking at this. So here's the takeaway. It's not to say we won't rally $100. It's only to say if the next $100 can be up or down, then decide if you're holding on for another $500 or $1,000, as will happen over the next 4 years after the election. Doesn't matter who wins. Or you are in it for the next $100. Because given that the situation we are in is going to have major forces opposing each other.
The current market dynamics of gold underscore its resilience and appeal as a safe haven asset. With rising prices amid an emerging sell season, driven by new buyers and strong demand from global central banks, gold's performance signals a fundamental shift in investment behavior. The notable gains of about 12% in major trading venues highlight gold's enduring strength and its essential role in investor portfolios. What are your predictions for gold prices in the coming months? Share your thoughts in the comments below. If you found this video informative, don't forget to hit the like button and subscribe for more insights on gold and the markets. Stay tuned for our next video, and remember to invest wisely. Thanks for watching.